Welcome students, I'm Dr. P. Vijayashree, Assistant Professor. Today we are going to see unit number 11, SEBI and its concepts and protection of investors' interest. This is from block 3, Capital Markets. Introduction about the SEBI. The Securities and Exchange Board of India, SEBI, is a statutory regulatory body established by the Government of India in 1992 to regulate the securities market in India and protect the interest investors in securities. SEBI is a statutory regulatory body established on the 12th April 1992. It monitors and regulates the Indian capital and securities market while ensuring to protect the interest of the investors, formulating regulations and guidelines. The head office of the SEBI is at Bandra Kurla Complex, Mumbai. SEBI is known as to be Securities and Exchange Board of India. The SEBI is the controller for the securities market in India. It was launched in 1922 under the SEBI Act. It is known to be a regulatory body of government in India. SEBI plays an essential part in monitoring all the performance working in the Indian capital markets. Meaning, SEBI full form is Securities and Exchange Board of India, and it is a statutory regulatory body established by the Government of India to regulate the securities market in India and protect the interest of investors in securities. It also regulates the functioning of the stock market, mutual funds, etc. Formation of SEBI. At the end of the 1970s and during 1980s, capital markets were emerging as a new sensation among the individuals of India. Many malpractices started taking place, such as unofficial self-styled merchant bankers, unofficial private placements, rigging of prices, non-adherence of provisions of the Companies Act, violation of rules and regulations of stock exchanges, delay in delivery of shares, price rigging, etc. Due to these malpractices, people started losing confidence in the stock market. The government felt a sudden need to set up an authority to regulate the working and reduce these malpractices. As a result, the government came up with the establishment of SEBI. SEBI was established to keep a check on unfair and malpractices and protect the investors from such malpractices. The organization was created to meet the requirements of the following three groups. Actually, this is formed to protect these three members, that is, insurers, intermediaries, investors, issuers. Objectives of SEBI. The following are the objectives of the SEBI: to deal with development and regulation of stock market in India, to promote safe dealings by the issue of securities and ensure a marketplace where they can raise funds, to provide protection to the investors, to have a check on preferential allotment to promoters at a very low price, regulate and develop a code of conduct for brokers, merchant bankers, etc., to prevent deviations and violations of rules prescribed by stock exchange, to verify listing requirements, listing procedures, and ensure compliance of the same by the companies so that only financially sound companies are listed, to promote healthy growth of security market for the development of capital market in the country. And this is the structure of SEBI. Chairman, he was appointed by the Government of India, then two members, officers from Union Finance Ministry, and next one member from RBI, and the last 5 members appointed by the Union Government of India. This comprises the structure of SEBI. The board of SEBI comprises of 9 members. The board is an aggregate of the following: one chairman of the board appointed by the central government, one member appointed by central government, that is RBI, 2 board members hailing from the Ministry of Finance, 5 members elected by the central government of India. The chairman of SEBI, in addition to overseeing the board, also looks over the communications, vigilance, and the internal inspection department. There are 4 whole-time members in the organization structure. The whole-time members are located a number of departments that they have to oversee. Each department is individually headed by an executive director. The executive directors report to specific whole-time members. The organization structure of SEBI consists of more than 25 departments such as foreign portfolio investors and custodians, that is FPI and C, Corporation Finance Department CFD, Information Technology Department ITD, Department of Economic and Policy Analysis DEPA 1, 2 and 3, Investment Management Department, Legal Affairs Department, Treasury and Accounts Divisions TNA, and National Institute of Securities Market, that is NISM. Powers of SEBI. When it comes to stock exchanges, SEBI has a power to regulate and approve any laws related to functions in the stock exchanges. It has the powers to access the books of records and accounts for all the stock exchanges, and it can arrange for periodical checks and returns into the workings of the stock exchanges. It can also conducting hearing and pass judgments if their area malpractices detect on the stock exchanges. When it comes to the treatment of companies, it has the power to get companies listed and delisted from any stock exchange in the country. It can also make companies list their shares in more than one stock exchange if they see that it will be financial or beneficial to investors. Coming to investor protection, SEBI has the power to draft legal rules to ensure the protection of the general public. Then, role of SEBI. This regulatory authority acts as a watchdog for all the capital market participants, and its main purpose to provide such an environment for the financial market enthusiasts that facilitate the efficient and smooth working of the securities market. SEBI also plays an important role in the economy. To make this happen, this ensures that the three main participants of the financial market are taken care of, that is, issuers of securities, investors, and financial intermediaries. Issuers of securities. These are entities in the corporate field that raise funds from various sources in the market. This organization makes sure that they get a healthy and transparent environment for their needs. Next, investors. Investors are the ones who keep the markets active. This regulatory authority is responsible for maintaining an environment that is free from malpractices to restore the confidence of the general public who invest their hard-earned money in the markets. Financial intermediaries. These are the people who act as a middleman between the issuers and the investors. They make the financial transaction smooth and safe and secure. Guidelines of SEBI, SEBI Act and SEBI Guidelines. SEBI was established as a non-statutory body in 1988, entrusted with observing the stock market activities. The SEBI Act of 1922 converted SEBI into statutory authority with autonomous powers. The Act provided SEBI with the authority to regulate capital markets, not just observe but enforce guidelines. The SEBI Act 1992 covers the following areas: composition and actions of the SEBI board members, powers and functions of the board, fund sources of SEBI as in grants made available by the Union government, rules on penalties and legal pathways, defines the judicial authority of SEBI. The extent of the powers of the Union government to enhance SEBI. SEBI also has to adhere to a list of SEBI guidelines pertaining to areas such as employee stock option schemes, disclosure and investor protection norms, legal proceedings, anti-money laundering norms, listing and delisting of securities, opening of trading terminal overseas. Recent guidelines of SEBI 2021. Stock Exchange Board has announced that from September 1st, 2021, there will be a tectonic shift in India Stock Exchange, that is, the new intraday trading margin rules of the Securities and Exchange Board of India started with full force. In 2020, SEBI introduced the new margin rules for day traders, under which it was necessary for the stockbrokers to collect minimum margins on leverage-based trade upfront as against the earlier practice of collecting it at the end of the day. And these are the general percentage peak margin percentage of the SEBI. These are the phases, and this is the effective from, and this is the percentage of peak margins. Phase first is from December 2020, it's 25%, and phase 2, March 2021, 50% of the peak margins, and phase 3, June 2021, 75% of the peak margins, and phase 4, September 2021, 100% of peak margins. The main objective of SEBI in this whole exercise of peak margin system was for reducing speculation in the market so that retail investors do not end up incurring losses in volatile markets. The protests made by bodies like ANMI or the volumes will reduce the intraday market, but we do not see that when rules become effective. From the trader's perspective, they should be prepared for paying up margins upfront for any position in the market. For the brokers, this will surely reduce the risk of open op positions as they would be covered by margins for peak risk. Also, the shares bought today cannot be sold tomorrow, and the funds from today can be used tomorrow. Protection of investors' interest. Investors' protection. The investors' insurance money is a symbol of assurance. In simpler words, investor protection implies that up to a specific breaking point, you get your cash back if the dealer goes into bankruptcy or submits exhaustion. It is a significant factor to consider when you open a trading account or a record with an online dealer. At the point when you're opening an exchange account at a brokerage, you normally get financial backer security. Investor protection measures by SEBI. Investor protection measures by SEBI investor protection legislation is implemented by under the section of 11 clause 2 of SEBI Act. The measures areas follows: stock exchange and other securities market business regulation, registering and regulating the intermediaries of the business like brokers, transfer agents, bankers, trustees, registrars, portfolio managers, investment consultants, merchant bankers, etc. Recording and monitoring the work of custodians, depositors, participants, foreign investors, credit rating agencies, etc. Registering investment schemes like mutual fund and venture capital funds and regulating their functioning. Promotion and controlling of self-regulatory companies, keeping a check on frauds and unfair trade methods related to the securities market, observing and regulating major transaction and takeover of the companies, carry out investor awareness and education program, train the intermediaries of the business, inspecting and auditing the security exchanges, that is SEs, and intermediaries, assessment office offers and other charges. Investors protection measures by SEBI updated on March 3, 2022. 1,31,536 views investors are the pillar of the financial and securities market. They determine the level of activity in the market. They put the money in funds, stocks, etc. to help grow the market and thus the economy. It is very important to protect the interest of the investors. Investor protection involves various measures established to protect the interest of investors from malpractices. Securities and Exchange Board of India (SEBI) is responsible for regulations of the mutual funds and safeguard the interest of the investors. Investor protection measures by SEBI are in place to safeguard the investors from the malpractices in shares, the stock market, mutual fund, etc. Thank you. This is the end of our session. Thank you.